All right. Today is Thursday, March 17th, and this is a recap of the stock market activities today. Folks, I got a good one for you tonight, and let's dive right into it. In focus. Let's talk macro, specifically inflation and retail sales. Then let's talk about uranium because we have a lot of action in that particular commodity. And lastly, the post FOMC market reaction. Now, let's start by this. This is a chart that I shared with you a few days ago. It is the inflation in goods versus inflation in services. And as you can see, inflation in goods continues to move higher, while inflation in services is plateauing and trending down. And I explained to you that this is an evidence for stagflation in the economy because we're seeing consumers being forced to spend more on goods, chasing inflation, and by doing that, they have to allocate their budget and spend less on services, and hence we will see the phenomenon of stagflation, higher prices, yet a slowing down of the pace of economic activities. And yesterday and today we got more evidence to support this theory. For example, today we got the Fed Philly Manufacturing Survey, and as you can see, the index, the headline reading, is actually stabilizing, but it remains below the highs, meaning the pace of economic activities is stagnating. On the other hand, when we look at the prices paid and prices received according to the Philly Fed Manufacturing Survey, they continue to go higher and higher and higher, hence stagflation. And yesterday we got retail sales. Well, the headline reads, Americans slowed their spending in February as prices for food, gasoline, toothpaste, as overall prices of most things continue rising due to inflation. Retail sales increased 0.3% after registering a revised 4.9% jump from December to January. So what's going on here? Why are we seeing retail sales plateauing and not moving higher again? They keep telling us that the consumer is so strong and flush with cash. You and I know that that's bullshit, but when we look at spending by category, which categories moved higher? It might be hard to see, but you pause and you look at it. I can see gas stations in light blue moving significantly higher, and this is month over month, of course. I can see food and beverage in green moving higher. I can see general merchandise in brown also moving higher. But here's perhaps a better illustration for all of that. In the month of February, we're seeing less retail spending on non-store retailers, meaning Amazon and the stuff that people usually buy. But we're seeing more spending in gas stations and food. And this is not surprising because when we got the CPI reading last time around, we're seeing insane inflation in energy and food prices. And of course, the cooks and the propagandists keep saying X food and energy, X food and energy. How about X oxygen? Just to play down inflation data. Well, energy and food are highly critical to households' budgets. But anyways, we got a survey from Quinnipiac University that asks, how much of a problem has the price of gasoline been for you and your family lately? A very serious problem, a somewhat serious problem, a not too serious problem, or not a problem at all. The majority, 37%, say it is a very serious problem. 54% of Republicans agree, while only 13% of Democrats say it is a very serious problem. Either they're all driving Teslas and EVs, or they're really rich, or maybe they're just heavily propagandized. Independents, about 41% say it is a very serious problem. Now, as you can see, when we go down by income, 50% of those households earning less than $30,000 say it is a very serious problem, versus only 28% of those earning more than $100,000 saying it is a very serious problem. So inflation, once again, hits the poor and the middle class the most. According to the same survey, when they asked, as a result of the recent rise in gas prices, have you cut back significantly on your household spending or not? 45% say yes, 54% say no. So far, we're not seeing the majority cutting back on spending significantly, but give them time and they will. Because we have 60% of Republicans saying yes, only 22% of Democrats say yes, 50% of independents say yes. Now, when we look at household income, those households with less than $30,000 in income, 59% of those say yes. We had to cut back on spending significantly. So again, it hurts the poor and the middle class the most, but we're starting to see this shift of consumers having to cut back on certain spending to factor in this case, for gas inflation. And this will fuel more stagflation in the economy. But we're also seeing reckless behavior by the consumer. We're seeing the consumer, for example, swiping those credit cards up and down, up and down, up and down. We're also seeing a phenomenon of the buy now, pay later stupidity. And the American consumer is now using buy now, pay later, Affirm and the likes, and then using credit cards to pay that debt. Unbelievable. The recklessness is absolutely stunning. Are these people aware that they could lose their job, number one? And oh, by the way, interest rates continue to move higher. When we had a 0% Fed funds rate, the average credit card interest was at 16%. Can you imagine what will happen to those rates when the Fed's funds rate go to, let's say, 3%? Maybe we'll see 50% interest rate on credit cards, maybe 100%. Are these people even thinking about the ramifications? They keep telling us this time it's different. We're not going to have a recession or a crash because the consumer is flush with cash. We're not seeing a lot of risk taking like we saw back in 2007, 2008. What do you call this? And oh, by the way, we have MasterCard now jumping on the wagon of buy now, pay later, or never. So perhaps this is the next shorting idea, right? And again, inflation is not stopping. Every dip in inflation is being bought. Inflation continues to move higher and higher and higher, while the pace of economic activities continues to stagnate and move down. Once these credit cards are all racked up, what happens then? You see, they told us that the poster boy for transitory inflation would be used cars inflation, the prices of used cars. Bullshit. As you can see, used cars prices are moving higher again. And the reason is the supply of new cars is nowhere to be found. We're past the thing right now. They told us that inflation and the supply chain problems are due to the thing. Well, the thing is gone, and we're still having problems. Why? Because the thing was not responsible for inflation and the supply chain woes. It was the cocaine by the Fed, the loose, easy money printed out of thin air, trillions and trillions of dollars. And oh, by the way, add to all of that the supply chain woes and the inflation from the Russia-Ukraine war and the sanctions and the restrictions of all of these supplies to move to factories to build new cars. And if you're looking for a sedan, I'm a sedan guy myself. I don't understand the SUV mania. I like those big sedans, old school, but they're nowhere to be found. The supply of sedans is pretty much at all-time lows. So again, the prices of these cars, used cars, will continue to move higher and higher and higher. And I keep telling you, if you have a beater, an old beater car, specifically a reliable beater, like a Toyota or a Honda, you might want to change the oil and maintain that one because it's going to be worth a lot at some point, and you might actually need it. Let's say if there's a zombie apocalypse, for example, your EV is not going to take you so far. You need that car. Anyways, but they keep telling us, hey, you got to switch to the EVs, and who cares about the prices of used vehicles and the gas combustion vehicles? That's old. You got to join the new movement of EVs. Well, where are the damn EVs? And how affordable are they? And will they be affordable with the insane inflation in materials costs? Nickel, aluminum, lithium, cobalt, because we now even have Germany backing the EU proposal that only emission-free cars and vans can be sold from 2035. So this stupidity of the EV mania will continue to go on because it is part of the globalist agenda, the satanic cult, the cabal, the World Economic Forum, Brookings Institution, Smithsonian, you know the rest. In the meantime, until these EVs reach the market finally, and by the way, there is no guarantee that these cars will be affordable after all of this inflation, but until they arrive, the prices of used cars will continue to move higher and higher and higher, hence the stagflation phenomenon. Now, let's segue to uranium, and it kind of ties in with the EV mania and inflation because, as you can see, energy costs are soaring as a proportion of global GDP, and so far, coal, oil, and gas are responsible for this surge of energy costs. What is the alternative for now? Because they continue to talk about green energy, renewable energy. That's going to be years from now, if ever. Look at the scarcity of materials for the so-called renewable energy, where we have all of these countries and companies competing for the same materials, for the same resources. The prices will spiral out of control. And you're going to have the average EV when it finally hits the market at around 60, 70, if not 80 grand. Who's going to afford all of that? But most importantly, when we talk about countries, they spend a lot on gas, oil, coal for electricity and power. What is the closest, perhaps the easiest way to transition from fossil fuels until the so-called renewable energy arrives? The answer is nuclear. Perhaps nuclear is the green energy, the true green energy. But again, it's not part of the globalist agenda, so it's not cool. Regardless, we're seeing a movement toward green energy. For example, today we heard from the Czech Republic, who's building a nuclear reactor for at least $7 billion, because this is the most rational alternative to fossil fuels, at least for now. We will continue to see more and more appeal for nuclear energy. A critical component of nuclear energy happens to be uranium. Well, where does uranium come from? The answer is the top 3 producers, at least today. Number 1, Kazakhstan. Number 2, Canada. Number 3, Australia. Now you understand why I like the Canadian and the Australian economies right now. They produce all kind of materials, nickel, palladium, lithium, and Australia produces coal, lots of coal, but they also produce a lot of grains. We have shortages across the globe. These 2 countries will thrive under these conditions, assuming, of course, the stupid leadership is going to allow mining and extraction of these resources. But anyhow, if we're going to see this transition into nuclear energy, where are we going to get the uranium from? You could say, how about north of the border, Canada? Well, they have regulations over there to produce uranium on a mass scale. So the alternative is Kazakhstan. Here's the problem. Your genius politicians, of course, your beloved politicians, I should say, they're now introducing a new bill to ban Russian imports of uranium. Yes, Russia happens to be one of the top producers of uranium. But in this bill, there is a proposal to ban uranium imports from Russian allies, among them Kazakhstan. You see, there is only few financial commentators out there, me and maybe a handful of other commentators, sounding the alarm about the stupidity of these sanctions and boycotts and embargoes. Number 1, what is the wisdom behind that? Number 2, what is the exit strategy, because we cannot live with this inflation for so long? Number 3, aren't we empowering China by doing all of these sanctions and pulling out of the Russian market? It leaves a gap, a hole, that will be filled by China. And by the way, how are these sanctions going so far in stopping Putin and the war? Because all I see is more escalations of more people dying. So to the sheep and the war propagandists out there, how many dead Ukrainian kids you want to see before you admit that you're wrong and your warmongering chauvinist style of sanctions or boycotts instead of pushing for peace is not working? You're the same people who told us that the people who are not getting the jabs should be fired from their jobs. They should be homeless. Who cares? Matter of fact, according to surveys, a lot of the sheep were supporting jail time for those who refused to get the jab. And when we told you, what about the natural protection of people who got infected already? That's just propaganda. Well, now you're proving that you're wrong. Are you apologizing? Of course not. Crickets. Nothing at all. And you're going to be proven wrong on this issue too. That all of this stupidity is going to cause more inflation and harm the global economy, the average American household, specifically the poor and the middle class, and it's not going to stop the war. And the end result will be empowering China. But anyhow, this is from the zombie senator who's proposing all of this. Banning Russian uranium imports will further defund Russia's war machine, help revive American uranium production, good luck, with all the greenies out there, not gonna happen, and increase our national security. Here's the problem. The United States has over 90 nuclear reactions, more than any other country, and it is heavily reliant on imported uranium. Russian uranium made up 16% of U.S. purchases in 2020, according to the Energy Information Administration, with Canada and Kazakhstan each providing 22%. So let's say we ban Russia and Kazakhstan. We lost what? 38% of the uranium supply? What is that going to do? Prices of uranium will move higher and higher and higher. And it's gonna benefit Russia and Kazakhstan at the end of the day. You morons. In the meantime, how do we profit from all of this stupidity? How about we buy uranium, for example? Here's a weekly chart for the ticker URA. This is the global uranium ETF. As you can see, it has a trend line, a beautiful bounce from the trend line. And now we have, look at the MACD indicator and the RSI indicator. Those are the momentum indicators. They're pointing out for a higher move in this chart. And it makes sense, folks. If we're going to cut uranium supplies from Russia and Kazakhstan, then we're going to have a scarcity, and this will push prices higher, just like we saw with crude oil and wheat and palladium and nickel. Here's another chart, the ticker UEC, and this is a daily chart, by the way, and as you can see, we had a sloping line of resistance which was broken to the upside. Also, we have an important line of resistance that was broken and recaptured as support. 3.65. On top of that, we have a formation of a reverse head and shoulder, indicating that perhaps we could see higher highs in this chart. I did buy uranium today. This kind of stupidity will push uranium prices higher. And regardless, the demand for nuclear energy as an alternative for fossil fuels will increase, and this will push uranium prices even higher. Now, let's segue to the post-FOMC market reaction. The theme so far, year to date, has been dumping stocks, specifically the high multiple stocks, and raising cash, or investing in commodities and the stocks related to these commodities that are skyrocketing in value due to inflation. So, did the FOMC decision yesterday and the conference by Powell change all of that? Did anything change in the fundamentals? Did inflation go down for some reason? Did the Russia-Ukraine war stop for some reason? Are we seeing crude oil prices crashing? Well, we saw them crashing, but they did rebound today again, and they will move higher, perhaps make new highs. So nothing changed here, and the Fed is actually more hawkish now, at least according to the words, not the action so far. On the other hand, across the Atlantic, the ECB remains delusional, out of touch at all. Madame Lagarde, the delusional madwoman that she is, she said that the ECB has extra space, quote unquote, before the first rate hike. Really? Extra space? Do you want to see what diesel prices look like across your continent, Mrs. Lagarde? Absolutely delusional. And by the way, the ECB's projection for inflation was way off. The projection said that inflation will peak at around December of last year. What are we seeing so far? Inflation is exploding across Europe. But I know it was supposed to be transitory, and it became not transitory because Russia-Ukraine. Let's hang all of our excuses on Russia-Ukraine, you geniuses. So again, did anything change, fundamentally change, after the FOMC or after Powell? The answer is not really. Nothing changed. Inflation continues to skyrocket. The scarcity of supply in certain commodities continues to go on. The supply chain woes continue to go on. The Russia-Ukraine war continues to go on. So why would we change tactics in the stock market right now? It is stupid. It doesn't make sense. So right now, I'm sticking with the winners. These are just some of the names. Not all of them. We have a lot of winners. We have a lot of good stocks that I happen to own in my portfolio, but I shared with you these names yesterday, so I'm going to stick with them. Now, if anything changed after the FOMC, then we should have seen, at least today, a rotation from these winners into the losers. The software names, chips, the high multiple names, the speculative names. This is not what's happening. We're seeing those names bouncing based on oversold technicals for now, as trades, not as investments. And on top of that, today, these names, the majority of them at least, managed to close in the green. So there is no rotation out of these names because nothing changed, at least for now. Berkshire Hathaway was up, Freeport was up, Lockheed was up, ADM up, Mosaic up, Nutrien up, ZIM, this is a Israeli shipping company that I happen to like. I bought it back in the IPO. I thought it was a reasonable valuation. It was down today, but it is a winner year to date. Now, if you want to look at perhaps a more established marine shipper, look for Matson, the ticker MATX. But keep in mind, all of these charts are still overbought, technically speaking. So if there is anything that will change the story, fundamentally speaking, at least on temporary basis, let's say rumors of a peace deal between Russia and Ukraine, you're going to see these names dropping down. This is the risk. There is nothing such as risk-free. We also have John Deere up today, Union Pacific pretty much flat, Alcoa up big, almost 7%, Chevron up, Occidental up, and by the way, your boy Buffett still buying and adding to Occidental. He continues to buy his own shares of Berkshire Hathaway, but even Marathon was up, Hershey's was up, but be careful with Hershey's because they have some entanglements with Russia. If you lose the Russian market, it might be small as a total share of revenues, but again, you're losing a slice of your entire revenue. Look at what happened to Mondelez, for example. Excellent company. I own it, but we've seen a lot of pain in the name because of the Russian market. Canadian Railway also in the green. AbbVie still in the green. Barrick Gold also. Kroger closing in the green. So again, I'm not seeing the rotation from winners to losers, at least not right now. I'm not convinced that I should sell these names and go ahead and buy software. Buy Snowflake, for example. Why would I do that? Nothing fundamentally changed in this market at all, or in the economic outlook. So I'm going to stick with the names that are beating inflation. And there are a lot of them, not just these names. Yes, we have a bull market within a bear market. There are a lot of charts, by the way, that are making all-time highs, while the majority of the stock market is in bear market territory. Anyhow, folks, we're going to move on to cover the market information for you, and we start with the closing of the indices, and here we go. The Dow Industrial Average closing in the green by 417.66 points, or a gain of 1.23%. The Nasdaq also closing in the green by 178.23 points, or a gain of 1.33%. The S&P 500 also closing in the green, no surprise here, by 53.81 points, or a gain of 1.23%. And here are the sectors' performances today, all in the green. We're not going to shame anybody here, but this time around, the leadership was different. Number 1, capturing the gold medal, energy. Number 2, capturing the silver, materials. Number 3 for the bronze, healthcare. This is not technology. This is not cyclicals, not communication services. So again, the winners, the year-to-date winners, are now back at the leadership positions, at least by today's activities. What does that tell you? I'm sticking with the winners. I'm not dumping energy. Somebody gotta persuade me with a solid argument with the facts that the fundamentals are changing and I should dump energy and buy software. I haven't heard a legitimate argument yet. Moving on to the advance to decline ratios. NYSE 76% advancing versus 22% declining. The Nasdaq 73% advancing versus 23% declining. What about commodities? Here comes the rebound in crude. The WTI closing the day with gains of a little over 9%. Likewise, Brent also closed the day with gains of 9.25%. Likewise, gasoline up big today, over 7% gains. Heating oil closing the day with gains of almost 13%. Natural gas up almost 4% today. So again, inflation is not transitory. The dip in inflation is. What about softs? Here comes lumber, leading the pack with gains of almost 5% today. We also have gains in cotton, closing the day with almost 2% in the green. Sugar, also a gainer today, closing the day with gains of almost 1%. On the other hand, we have OJ pretty much in the flat line. We also have losses led by coffee and cocoa. What about metals? Green across the board. Gold up, silver up, platinum up, copper up, palladium, most importantly up, closing the day with gains of over 6%. So again, we're seeing the revival of the Russia-Ukraine trade, the revival of the inflation trade, oil, palladium, wheat, nickel, all moving higher again. What about meats? We have a down day, almost 2%, for the new big tech lean hogs, not acting good, at least not recently. We also have feeder cattle futures down by almost 1%, while live cattle futures pretty much on the flat line. Lastly, grains, gains across the board. We're watching wheat. Wheat was up almost 2% today. Corn was up a little over 3%. Soybean oil also in the green. Oats, canola, soybeans, all closing the day with gains of over 1% today. On the other hand, the decliners were rough rice and soybean meal, both losing almost 1% today. Now, we're seeing some shipments of these agricultural products from Russia, Ukraine, but not a lot. For example, AgFlow released this map showing the flow of vessels carrying agricultural products from Russia in the month of March, at least the 2 weeks so far. And the map shows about 73 vessels versus the 220 vessels that were moving out of Russia to other ports during the same period of last year. So yes, some goods are still moving out of Russia, but we have a significant reduction of the supply, and this will push grains prices higher. No doubt about it. Moving on to the big casino, the options market. What's going on here? The volume is down. All in all, is this a good sign that we have a legitimate rally? Or is this a sign that we're having a bear market rally that's going to fade? I'd go with the latter, because if this was a legitimate bottom and the retail crowd believed that it is a legitimate bottom, we would have seen elevated options volume across the board, but specifically for calls. This is not what we're seeing. We're seeing more people buying puts. But regardless, Apple came at number 1 with almost 950,000 contracts traded today. About 58.5% of those were calls. And at number 2, TSLA, Tesla, the souffle, with almost 850,000 contracts. About 54.5% of those were calls. And at number 3, AMD, with a little over 600,000 contracts traded for the name today. About 58% of those were calls. Alibaba's dropping down, still at number 4, but the name was down today, and now you have people scared of buying calls because there were pies. served today. I mean, the name was up over 30% yesterday. You think people are not going to take profits out of this one? Think again. But here are the unusual activities that took place in the options market today. We start with the ticker EWZ for the Brazilian ETF. This is a strangle trade, meaning the trader is expecting a massive move one way or the other, but they're not sure which way it's going to be. So they're buying puts and calls. In this case, they bought the 31 puts and they bought the 36 calls for the expiration date, April 22nd, with the expectations that the EWZ could move up by over 6.5% or it could move down by more than 8% by the expiration date. So they're buying both. And it cost them 50 cents a piece for each trade, all in all spending about $1 a piece, and that brings the total to about $5 million. What about the ticker ARKK for Tesla witch Cathie Wood? Nice gains in the last few days, but somebody's fading the rip because it is a bear market rally. In this case, they're buying the 55 puts for the expiration date, April 22nd, with the expectations that RKKKK could drop down by more than 12.5% by then, and they paid about $2 a piece to enter this trade, all in all spending about $2.2 million. And what about the call spread for Snapchat? They bought the 37 calls and they sold the 40 calls, all for the expiration date April 1st, with the expectations that Snapchat could move higher by more than 9%, but not more than 18% by then. They paid about 80 cents a piece for buying the 37 calls. They received about 30 cents a piece from selling the 40 calls. All in all, they're down to 50 cents a piece for this trade. That brings the total to about $400,000. What about the trade for the ticker KRE? The spread is wide in this one, so it is insignificant, but perhaps the messaging behind the trade is important because the KRE is a proxy for the 10-year yield. Regional banks, which the KRE represents, benefit tremendously from the movement of the 10-year yield higher. But when the 10-year yield goes down, these banks tend to underperform. Somebody's buying puts in the KRE, perhaps betting that the 10-year yield will drop down. Maybe more flare-up in the Russia-Ukraine front around the corner, who knows? But in this case, they bought the 64 puts for the expiration date, April 22nd, with the expectations that the name could drop down by more than 11% by then. They paid around $3 a piece to enter this trade, all in all spending about $1.5 million. Lastly, what about the trade for the ticker GKOS or Glaukos? If the name did not give it away, it's a company that specializes in glaucoma treatments. Somebody's buying puts. This is a performer year to date, excellent performer, well off the highs, but somebody is buying puts, betting for more downside to come. In this case, they bought the $50 puts with the expiration date April 14th, with the expectations that the name could drop down by more than 10% by then. They paid around $2 a piece to enter this trade, all in all spending about $1.5 million. Moving on to the heat map analysis, what's going on here? We still have the tide that lifts all boats, the short covering the algos, but here's the problem. The fire behind the rebound in technology, software, chips, the big caps kind of faded away. And the fire behind the rebound in Chinese stocks completely went dark. Is there a message there? I think so. I think we have a lot of market participants believing that these rebounds are transitory due to oversold conditions and perhaps bear market rallies. But what did they buy today? Aggressively speaking, they bought big pharma, they bought energy again, they bought the agricultural stocks, materials, copper, aluminum, Alcoa, they bought Deere, they bought UPS, they bought Caterpillar, and that tells me the consensus for now is stick with the winners and just trade the losers. When we have bounces, when we have oversold conditions, we trade these bounces and then we move on until the fundamentals change. And we have some news for certain stocks here. Let's talk about defense, and we're seeing massive defense spending across the globe. Today we got the news that the US will provide Egypt with F-15 jets, so the spending on steroids on defense continues to go on. Now, when it comes to energy, I know a lot of you like the refiners because they happen to be high beta names. They move impulsively higher when the pops happen, and a lot of options traders prefer that. But as an investment, I'm sticking with the big guys. I'm sticking with the guys who are digging the oil off the ground. I'm sticking with the guys who are selling the gas at the station. I'm not sticking with the in-between, the downstream and the upstream, the refiners, because higher prices are not going to benefit them either way. They might benefit here and there, but the majority of the benefit will happen to the companies that dig the oil from the ground, and specifically the companies that sell that oil as gas at the station. So I'm sticking with Exxon, Chevron, maybe Occidental and Marathon, but you got to be careful with the refiners. Now, all of these companies, the refiners, will have to find a substitute for all of the Russian oil they use to refine. If they cannot find an alternative, they're losing business. And I know all of these names move together higher due to the ETFization impact of the market, but in the long run, sticking with the pure winners is always a smart strategy. We also have Netflix. Remember when they told us we have to buy the dip in Netflix because it went down big after earnings? Kramer was screaming at the top of his lungs, "You gotta buy the dip. Netflix, it's the future, bro." And then came Ackman buying the dip. What do you know? Then the stock kept going down and down and down. And now Netflix is cracking down on passwords. Yep, don't share those passwords. Otherwise, we're going to shame you publicly. This is desperate. If you're now chasing password sharing, something fundamentally going wrong with this company. And what about the heat map for the ETFs? Again, the rebound of energy XOP, XLE, OIH, the rebound in the XME materials, the rebound in consumer staples, the XLP, but we're not seeing dumping of technology, for example. The XLK still green, SOXX, SMH still green, but be it kind of weak. We're expecting another pop. It didn't happen. The XLF still holding, but look at the KRE, started to move down. Healthcare, biotech, the XBI still holding, adding more gains. And when you look at the contrast between growth and value, yesterday growth outperformed value by a lot. Today they're pretty much neck to neck. So again, I'm not going to read into it a lot, but are we seeing the fact that these bounces, impulsive bear market rallies, are just mere bear market rallies, and then they go out of favor right away? Or we stick with the winners, energy, materials, the inflationary names? Perhaps, but we'll still keep an open mind that we could see more dip buying in technology, software, and the losers year to date. But perhaps a telling tale when we look at international markets, for example, the Chinese names got hit again. You're seeing profit taking right away. If there was conviction, why not add? Why not buy more Chinese stocks? This is not what we're seeing. We're seeing market participants taking profits quickly when these bounces happen. And again, I look for the consistency of performances in international markets. I like the EWZ, Brazil. I like the EWC, Canada. And I like the EWA for Australia. I also like the Indonesian ETF, the ticker INDO. But I'm not going to buy China or Europe right now. These are the losers year to date. They're going to bounce, they're going to have bear market rallies, and then what happens? You got to convince me otherwise. And before we wrap up, look at the VXX and the UVXY, the VIX proxies. UVXY down because the VIX was down big, but the VXX doesn't care at all. The VXX, matter of fact, closed in the green. The reason is they cut the supply. They kept these traders hanging. There is no more supply. And if these traders continue to hold on, then the VXX is not going to go down. This is a malfunction in the so-called market functioning. Right, Jerome Powell? But tomorrow, it's going to be really interesting to see how they're going to close the VXX, because you have people stuck with calls, puts. What are they going to do? So I'm going to be watching the VXX with a big bag of popcorn tomorrow. Moving on to charts, and we start with SPY, the S&P 500 30 minutes chart. It looked good yesterday. The chart was super bullish, as I said. What do you know? The SPY continues to move higher, this time around capturing 438 as support. Now, here's the problem. Look at the RSI indicator from a 30 minutes perspective. It is becoming overbought. It is becoming overextended. That doesn't mean by default that the chart has to go down. But we also have options expiration, and we have Friday's closing. After a massive rally from the bottom in a short amount of time, is it reasonable to say that we could see a pullback, a profit-taking pullback on Friday, because we have this assumption that this is a bear market and we're seeing bear market rallies? You take profits right away. So again, is it reasonable to say that the chart could pull back all the way to 438, if not 434? That is a possibility. It is reasonable to assume that we could see a pullback. And tomorrow's closing will be a sentiment test in the market overall. Because if we see another leg higher in the SPY, regardless, and we see, let's say, 443 as support, if not 446.5, what is that going to say? Perhaps the assumption of a bear market rally changes to what if this is a legitimate bottom for now, because we're going to have a closing from a weekly perspective above 430, and a higher closing tomorrow will mean that we did not see weak hands who bought the dip as a trade with the assumption that this is a dead cat bounce, a bear market rally, a sucker's bounce, a relief rally, an oversold rally, whatever you want to call it, and they're going to book profit quickly. If we see an upside day tomorrow, that assumption goes out of the window, and that would be super bullish. So the closing tomorrow is highly critical. The SPY made significant advances. The most important one is the fact that it's trading above 430. And remember, the SPY includes energy, it includes materials, it includes agricultural names, it includes banks. It is more diverse than the concentration of tech that we see in the Qs. What about the daily chart for the continuous contract for the S&P 500 futures? The chart managed to close above another important support level, 4,384.5, but it appears so far in the aftermarket session to be struggling to hold that level. The volume went down significantly today. This is, believe it or not, a good sign and a bad sign for the bulls. A good sign because it affirms that the selling is drying out. The volume is receding, but it is a bad sign because it also says that we're not seeing conviction in the buying so far, and that could mean that the buying that we saw so far might have been done by algos and short covering, not legitimate buying, not institutional buying. But regardless, the momentum indicators are moving higher. The best case scenario for the bulls is not to have an impulsive rally tomorrow, because if that is the case, who's to say that we're not going to see a gap and crap and taking profits right away? What you want to see is consolidation at around 4,384.5. This will be a test for the weaker hands. Are they going to give up and sell right away, or are they going to continue to hold? And if they do, and the chart consolidates for a little while, it will be a process of building energy and asking, where are the sellers? Any sellers? Anybody wants to take this chart down? If the sellers don't show up, the buyers will. The buyers who missed out on the rebound so far, they have FOMO when they see consolidation and no big drops like we've been seeing so far. They're going to have the security and the comfort to jump on the wagon and buy. We will see the SPY moving higher. So I hope this is clear and not confusing when I say that the consolidation around 4,384.5 is the best case scenario for the bulls. The bears, of course, are hoping that in usual charting behavior, when you break above a sloping line of resistance, you see a revisit the same line. This time around is support, and usually, not always, we see a rebound and a bounce higher after the revisit of that line and confirming it as support. Yet what the bears are betting on is the fact that this retest could fail, and we could see the chart breaking 4,232 once again. But you're not going to short until that happens, breaking 4,232, because what if we see an ABC formation? And I will show you that in the chart of the Qs. And here it is, a 30-minute chart for the Qs, the Nasdaq, another move higher, an impulsive move higher, and the chart is now trading above the important line of 343. So far this week, massive progress for the bulls. The problem is we have overbought conditions, overextended conditions of the RSI, which could merit a pullback. So will this chart close above or below 343? The bulls would hope for a pullback, at least in the morning, a gap down, and then we see more buying and the chart eventually closes the day above 343. That would be, once again, super bullish because you went down, you shaked off the weak hands, the buyers showed up again, and the chart managed to close above the important line. And here it is. What about a chart, a daily chart for the continuous contract for the Nasdaq? We're now above 14,000, so again, more progress for the bulls. The momentum indicators are moving higher. This is all a good sign for the bulls again. The volume slightly to the downside, below yesterday's volume, below average all in all. This is again a double-edged sword, a good sign for the bulls that perhaps the volume is drying out. We're not seeing the sellers being as crazy as they used to be, at least in the last few weeks. But it also means that we're not seeing a buildup, a conviction in the buying. Now the bears must not jump in and short until and unless we see 13,599 broken as support, because even if the chart goes down, who's to say that this is not going to be an ABC pattern? And sooner or later we see the B leg to the downside, but after that comes the C leg and we make higher highs all the way to 14,445. And here's a 30 minutes chart for the IWM, the Russell 2000 small caps, another massive rally high higher. A lot of progress. The chart closed above 204.5. This is a good sign for the IWM bulls. But here's the problem. Look at the momentum indicators, the MACD, the RSI, they're all overextended to the upside, meaning overbought, which merits a pullback. And if we see a pullback again, the question is, will the chart close at the lows of the day and loses 204.5, or will we see the buyers showing up again and the chart closing above 204.5? The latter scenario is, of course, the best scenario for the bulls. And here it is, the Dixie, the dollar index, daily chart. Perhaps we have a confirmation now because we have negative divergences on both the RSI and the MACD indicator. We have a double top formation, which means that sooner or later the Dixie should move down and retest 97 as support. And if that is the case, this will be good for the stock market because it relieves a lot of pressure, a lot of margin pressure from the rise in the Dixie, but it will be particularly good for international markets. It will also be good for gold and good for oil, and hence good for inflation. So it is a double-edged sword. At least for equities. You get a relief from the margin pressure, but again, you move inflation higher, and here comes the margin pressure once again. Now, when we talk about the dollar in hiking cycles, traditionally speaking, at least in the past few times when we saw hiking cycles, the dollar tends to go down, not up. So this is the assumption so far, but you got to remember this. All of these cycles, the tightening cycles, back in 2015, 2004, 99, and 94, all of these were transitory hiking cycles because guess what happened? The stock market went down and the Fed stepped in to ease once again. So perhaps the closest scenario that we're looking at is back during the Volcker era. But even if you look back at the 70s, for example, the great inflation of the 70s, the dollar was going down and gold was spiking higher. Rates were spiking higher. This is not what we're seeing so far in this inflation. We're not seeing the dollar crashing. We're not seeing gold spiking, at least not until recently. We're not seeing yields spiking, at least not until recently. We haven't even seen the velocity of money moving higher. And a lot of you last year kept telling me, bro, you're wrong about inflation. Inflation is going to be transitory because we're not seeing the velocity of money moving higher. The dollar is not crashing. Gold is not moving higher. Yields are not moving higher. And I told you, all of that means shit right now because the Fed distorted markets so much that he can't even look back in history and make assumptions based on what we know. You got to use your head and use creative thinking, and you'd come up with a conclusion that inflation is not going to be transitory because we're overstimulating an economy that did not need stimulation. For example, look at the correlation between the dollar and the average difference between the 2-year yield in the US and other economies. As the 2-year yield opens a gap with other economies, here in the US, we're seeing the dollar moving higher. So if the dollar is about to move down, the assumption is the 2-year will also move down. And this is yet another indicator, by the way, that the weakness of international markets and other economies, specifically the weakness of international currencies, is, along with the Fed's manipulation, what kept the dollar trading higher, even amidst this massive inflation. And here's the daily chart for gold. Gold is moving higher, and it recaptured the Fibonacci support. I bought some of the miners yesterday. At least the names that I already own, I bought some more, and I buy miners, not gold futures, because they tend to move higher, and I get yield on top of that, dividend. But you gotta be careful here in buying gold. Maybe a few more days in the green will seal the deal, because what if this is a head and shoulder formation? And we're gonna see lower lows for gold, perhaps all the way down to revisit the sloping line of resistance, assumingly this time around it will be support, and this is 101 charting behavior. And again, what if this is a reverse ABC pattern, which will take us down to the same destination? You got to keep an open mind. So again, the test for gold will be maybe a few more days of gains, and that would seal the deal that we're not going to see a head and shoulder or a reverse ABC pattern. Now, what about the 10-year yield from a daily chart perspective? It is topping. So absent of an exogenous event, Russia, Ukraine, whatever it is, that will pop this chart higher, the assumption is it's going to cool down. We're going to see the 10-year cooling down a little bit, perhaps not all the way down to 1.94, but a drop in the 10-year yield will not be good for the KRE, for example, regional banks, but it will be good for technology and the high multiple names. The problem is, would this chart drop for the good reasons or for the bad reasons? Meaning, will this chart drop for the good reasons, meaning inflation expectations move down down, and hence it would be a positive development for the Qs. But if this chart goes down for the bad reasons, meaning a rush to safety in buying bonds, and that could be due to a flare-up in the Russia-Ukraine front, then the Nasdaq will also go down. And here it is, the TLT, a weekly chart, a critical day tomorrow, because whether this chart closes above 134.5 or below will make a lot of difference in the trajectory of the bond market. A closing above 134.5 for the week could pave the way for more gains in the TLT. A closing below 134.5 will mean that this chart sooner or later will break below 128. And if that happens, yields will spike dramatically. You put two and two together, spiking yields are not that good for the Qs, the Nasdaq, the high multiple names. They're good for financials, so you can trade accordingly. What about the VIX, a 4 hours chart? Look at the MACD indicator. A failure to cross, creating green impressions in the histogram. We're seeing more red impressions instead, and this is green light for the SPY to continue to move higher. The problem is the VIX bottoming for now? Look at the RSI indicator from a 4 hours perspective. It is getting a little oversold, and it bounced from these levels before. On top of that, what if we have support at around 24.29? We see the VIX rebounding from that point on. Then we will see the SPY topping, perhaps in a gap and crap, and the VIX rebounding higher. And if that is the case, the question would be, will the VIX close the week above 33? If that is the case, then boy, that was an epic bull trap in the SPY. What about the VXN, the VIX for the Nasdaq 4 hours chart? Once again, what are we seeing in the MACD indicator? We're seeing red impressions in the histogram. We're seeing the chart making lower lows in the pattern. Matter of fact, broken the pattern, and this was green light for the Nasdaq to pop higher. The problem is, what if we have support at around 27.27? If the chart reaches there, perhaps it could rebound before that, and that would be the top for the Qs, at least for this leg. And the question would be, how far would the VXN go? If it goes all the way to 35 and it closes the week above 35, then again, we're going to have a solid case that this was a bull trap in the Nasdaq. Moving on to Apple, the daily chart, more progress for Apple. The momentum indicators are moving higher. The volume moved down in a sign that perhaps the selling is drying out and the peak of volatility is behind us. We'll see. But for now, the support remains 157 and the resistance at the upper range of the channel. What about Tesla? An hourly chart continues to move higher, and it stopped at around 866.14. Look at the RSI indicator. It is getting a little overbought, overextended. On top of that, the buying today was on lower than average volume, meaning no conviction, perhaps algos, perhaps short covering. So who's to say that we're not going to see a pullback? If we do see a pullback, how about 825.25 as support number 1 and then 802.41 as support number 2? Now the chart could continue to move higher, make no mistake about it. If that is the case, we're looking at 886. But my hunch is it's going to pull back. We're going to see profit taking on Friday. It doesn't mean that the pop is over in Tesla. Matter of fact, the bears should not really start shorting aggressively until and unless 802.41 is lost as support. We have more bad news for the souffle, by the way. Tesla fired an employee 6 days after he posted a YouTube video of his car running into traffic pylon while using the full self-driving or FSD, the car maker's controversial driver assistance system. So again, the souffle, a culture of secrecy and backstabbing, a culture of manipulation and fraud. The problem is, whatever you throw in this stock, it continues to hold on. It just shake it off, because this is the Tony Montana stock. You keep shooting at it, it doesn't die, until the skull comes from the back and seals the deal. What is the skull in this case? I don't know. Could it be the slowdown of growth in Tesla? We've seen that before. Could it be a controversy involving Reverend Elon Musk? Well, we've seen that before, but it could get worse. Who knows? Let me know in the comments, what is the skull that is going to seal the deal and crash Tesla right away? Because there is a psychological reason behind the resiliency of Tesla's stock. It is owned by a mass crowd of retail investors. And unlike the institutionals who have to buy and sell periodically, specifically when the fundamentals change or the monetary policy change, the retail crowd continues to hold on that Tesla's the future, bro, the robo-taxis, the flying cars, the electric dildos, and they continue to hold on. But at some point, they get shaken off. There's a point of pain where they have to sell. Margin calls start to hit. They lose faith of the story. We're not there yet. Something will get us there, but I don't know what it is. Moving on to tulips, BTC, no update. still in purgatory. The support 35,750, the resistance at around 42,000. Nothing to do here. What about AMC, an hourly chart? It is consolidating. The apes would have liked to see another pop higher, and unfortunately we have a development after hours, for the apes at least. GameStop is down. Could this impact AMC negatively and we see a closing of the week below 14.24? Because all in all, when you look at the pattern, at least for now, who's to say that this is not a cup and handle formation, which means we're gonna see more gains for the stock. But if GameStop ruins all of that, then it is what it is. And lastly, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have existing home sales, leading economic indicators, and we have another Fed zombie from Richmond, Tom barking. He's gonna be barking for a little bit. Who cares? And with that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.
Let's take it